Anyone with a smartphone or at least $100 can invest nowadays, and I'm going to give you a step-by-step guide on how to do it. And the first step is understanding why you should invest. There are two big reasons for this. Most people leave their money in a bank account, and over long periods of time, inflation means that your money actually loses value and you're able to buy less with your money than what you could previously. As an example, in the 1970s, a loaf of bread cost around 20 cents. It's now up over $4. Similarly, a litre of fuel cost around 10 cents per litre, and it's now up over $2. Inflation eats away at the buying power of your money. This is where investing comes in. You want your money to grow to at least keep up with inflation, but ideally outpace inflation. The second reason to invest is if you don't want to work forever, if you want to retire early, then you need to find substitutes for your salary and wages. You need to find other sources of income for your job. By building a large share portfolio, these shares can pay you dividends, which is a passive income. So that leads me to my next question: how do you make money in the stock market? The Australian Stock Exchange, or ASX, is a place where you can go to buy publicly listed companies. You might have heard of companies like the Commonwealth Bank, BHP, or Woolworths. These can be bought on the ASX. Other countries around the world have their own stock markets as well. And as an example, in the United States, their stock markets, you can buy companies such as Apple, Tesla, or Microsoft. When you buy a stock in a company, you become a part owner in that company. What this means is you get to vote at their annual meeting, and you become entitled to any profits that the company pays out in the form of a dividend. Now, if you couldn't be bothered voting, that's fine. You can purely have a passive role. You just sit back and wait for the dividends to hit your bank account. Now, there are generally two ways to make money on shares. The first is, you guessed it, dividends. If a company has a good year and it makes a profit, may elect to pay some of those profits out as dividends. Now, not all companies pay dividends, and there's no legal requirement for them to pay dividends, but generally speaking, the biggest companies on the ASX pay dividends twice a year. Let's take a look at BHP for an example. Now, as you can see, they've paid regular dividends twice a year for a number of years. You generally have to pay tax on any dividends you receive because they are a form of income. However, sometimes the company can attach what's called a franking credit, and what this simply means is the company has prepaid a little bit of the tax on your behalf. The second way to make money on shares is if they increase in value, and this is called capital growth. You generally only pay tax on this once you sell the shares. So if you continue to hold them and they continue to go up in value, this is called an unrealized gain, and you generally won't pay tax until you sell them. If you hold the shares for at least 1 year before you sell them and you make a capital gain, then you may be eligible for a capital gains tax 50% discount. This is a really good benefit, but make sure you seek the assistance of a tax accountant in determining your eligibility. So your next question might be, what stock should I invest in? There are normally two ways to invest. You can buy the stock in an individual company, which we've discussed, or you can buy a diversified option, which is called an index fund or an ETF. Let's get Lego Man to help us out with this one. Let's say Lego Man has the choice of buying each of these 3 individual blocks, and each block represents a stock in a different company. If Lego Man was going to do this, I would recommend that he thoroughly researches each company, has a deep understanding of how they work and their profit drivers, and then based on this make an estimate if they will increase in value over time. If this seems a little bit too difficult, a bit too complicated, then instead Lego Man can buy what's called an ETF, represented by this yellow block. And by buying this yellow block, Lego Man is indirectly buying shares in all 3 of those companies. This gives him a bit of diversification, and if one of those companies performs poorly, and then other companies in that ETF perform well, then they offset each other, which mitigates some of his risk. And there are ETFs for almost anything. For example, there are ones that track the top Australian companies, and there are others that track the top United States companies, and there are even ones that track the technology sector. Australia's most common index is called the ASX 200, which tracks the top 200 listed companies on the Australian Stock Exchange. The most common index in the United States is called the S&P 500, which tracks the largest 500 companies on the stock exchange. And while there can be some good profits made in picking individual stocks where those stocks take off, there's a famous statistic in the US where over the last 15 years, 88% of professional investors were not able to beat the S&P 500 index. So this effectively means you could have bought the S&P 500 index in a passive capacity and outperformed 88% of professional investors. If you ask me, those are pretty good odds. But please note, I'm not a licensed financial advisor, and nothing in this video should be taken to be financial advice or any recommendations to buy a particular stock. If you do decide that ETF investing is right for you, then you can Google Australian ETFs, do your own research, and pick the one that best suits your needs. The next step is choosing a brokerage provider. And this is really easy to do yourself with a smartphone. The days of calling up a broker on the phone to place a trade are long gone. The most important thing when choosing an online broker is if they are CHESS sponsored or not, and the cost of placing a trade. And both of these items have become far more competitive, with tech companies now moving in this space to provide a bit of competition to the big banks. And when I first started investing, it was mainly the big banks, and they would charge a minimum of $20 per trade. And when you're a small investor, a beginner investor just starting out, $20 is a lot, and you have to try and overcome this expense with the profit that's made on your shares. CHESS sponsorship simply means that the stock is registered in your name. This just gives you a layer of protection. So if the brokerage firm ever went into financial hardship, you should still be able to claim your stocks because they are legally registered in your name. And CHESS sponsored brokers have historically had higher transaction costs, because I guess there's more costs associated with running this service, and a higher minimum order quantity or minimum dollar value. This makes it really hard for bigger investors, but as I said, there's a lot more competition now in this space. Non-CHESS sponsored means that the shares are held on trust for you at the brokerage firm. They're in your name just purely for tracking purposes at the brokerage firm, but if they ever went into financial hardship, you may have some legal difficulties in getting the shares back. The benefit of non-CHESS sponsored brokers is they normally have much lower transaction fees and a much lower minimum order quantity, which is perfect for beginner investors. Normally, both types of brokers give you access to international markets, which means you can buy shares like Apple, Tesla, those sorts of things. And which broker you choose is ultimately your decision. At the time of making this video, I've researched some and include their transaction costs and if they are CHESS sponsored or not. But please note, these do change regularly. What I would say for beginner investors, a non-CHESS sponsored broker that has lower transaction fees and a lower minimum order quantity is totally fine. You can always transfer these shares to a CHESS-sponsored broker later on, just sometimes there's some fees associated with doing that. The psychology of investing. Now, the most important thing. You don't need a high level of intelligence to invest in the stock market. Warren Buffett said it best that it's more important to have a right temperament when investing than it is to have a really high IQ.
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess.
I would agree totally with you that a great IQ is not needed. I mean, you do not have to be terrifically smart to do well as an investor at all.
There are going to be days when your share portfolio is down. And in those times, you don't want to freak out and follow the crowd. This is a perfect example. If I showed you this stock price drop during the global financial crisis, you might get a little bit worried. You might freak out a little bit. However, if I zoom out, you can see that over the long run, the ASX has gone in an upward trend. Now, of course, past performance is not an indicator of future performance. But if you look at this chart over this period, we've had world wars, we've had recessions, we've had health epidemics, and the ASX has still moved in an upward trend. If you invest with a long-term mindset, you can mitigate some of these risks. And it's a well-known statistic that over the last 100 years, on average, the ASX has returned between 7 and 10% per year. This is another really good graph that shows the years the ASX has made a profit and the years where they've made a loss, and look at the difference between the two. Do not follow the crowd when it comes to investing. Set your plan and stay the course. How much should you invest? One of my key rules is never invest your rent money. You don't want to put yourself in financial hardship just for investing. Determine a sum of money that you can put aside each week that won't put you in financial hardship for investing. Some other things you should consider before you start investing is paying off all high interest debts such as credit cards. The interest rate on credit cards can be as high as 20%, which is absolutely nuts. So if you think about the average return of the ASX, which is 10%, 20% is double that. So by paying off your credit cards first, you're kind of saving yourself 20%. Another thing to consider is saving up enough money in an emergency fund in case you fall on any financial hardship. This is talked about in books such as like The Barefoot Investor, and anywhere from 3 to 6 months of expenses is recommended. And that's it. If you have any questions or if you enjoyed the video, please leave me a comment below and consider giving it a like. It helps push the video out to other viewers. And if you're interested in finance content, head over to my channel where I've got a whole bunch of videos on so many different financial topics I think you'll really enjoy. Take care, and I'll see you in the next video.